Meta platform's stock price jumped over 20% following its Q4 earnings announcement. Was that increase justified? I'm going to answer that question in this video, looking over the critical metrics from the earnings results. So let's get right into it. So overall, Meta prioritized profitability for fiscal year 2023, and that's the theme that got investors excited. Revenue still decreased by 4% in the fourth quarter to 32.2 billion. Meta's headwinds persisted throughout the fourth quarter, including the privacy policy changes made by Apple, competition from TikTok, and decreasing advertising demand due to fears of an economic recession. Earnings per share of $1.76 worsened from an earnings per share of $3.67 in the fourth quarter in the prior year. That's a significant decrease in earnings per share. The company ended the quarter with 2.96 billion daily active users. That was up 5% year over year. It's truly impressive that Meta Platforms continues to add so many millions of daily active users despite its massive scale. It reaches nearly half of the planet's population in terms of calculating them as users, and yet it's still adding millions of daily active users. That's truly impressive. Ad impressions increased by 23% and the price per ad fell by 22%. So here's a tale of two stories here. Ad impressions, this is the number of advertisements Facebook delivered, the number they showed. This was up 23% and really demonstrated its power over its business, right? If it chooses to, it can increase the amount of advertisements it shows. Sure, it might decrease the user experience a little bit, right? If you're seeing so many ads while you're browsing the platform, it's not going to make it as fun to browse the platform, and you may not engage with the app as often. But if Facebook wants to, it can boost up the number of ads that it shows and really boost sales and revenue as a result, right? It's got 3 billion daily active users who spend a considerable amount of time on the app. The troubling thing was the price per ad was down by 22%. This is a result again of its decreasing ability to sell targeted advertisements. Apple's privacy policy changes makes it more difficult for Facebook to collect the user data and then to sell targeted advertising. And so if there's less precision in the advertisements, then marketers are not willing to pay as high a price for those advertisements. And so that's why you're seeing the price per ad falling by 22%. Still, Facebook Meta Platforms repurchased 6.91 billion of its common stock and increased the repurchased authorization by $40 billion. This is a strong signal that Meta Platforms management is confident that its stock price is undervalued. And I've been saying this for a while now. Meta Platforms was one of my top stock picks for 2023. I recommended Meta Platforms as one of my top 23 stocks to buy in 2023. And I believe the stock was considerably undervalued. Management believes the stock is considerably undervalued, and management is spending billions of dollars to back up that statement that they believe the stock is undervalued. Another positive factor in its most recent quarter's results is that the company is now increasingly focusing on profitability. It's no longer just investing in the business with no abandon, with no regard. It did have 86,482 employees as of December 31st, but that will be reduced by 11,000 by the next update, right? So by the next quarter, you'll see that count come down by 11,000. That's a nice decrease, right? That's a more than 10% decrease in headcount. That trims a lot of the excess, that trims some of the excess spending on employees that the company has done over the years. And I believe that's going to bring expenses more in line with revenues now that revenues are not growing as quickly as they have been. Furthermore, management updated its expense forecast to 92 billion at the midpoint for 2023. This was down from the previous guidance of 97 billion. So they're going to spend $5 billion less than they were planning to on expenses. That's really good news for investors. And then capital expenditures of 31.5 billion forecast for 2023 is down from the previous forecast of 35.5 billion. So this is a $4 billion decrease in capex, which is money spent on things like office buildings, servers, computers, desks, and things like that. So spending less on those kinds of things and spending less on employees, the combination is about $9 billion lower expenses than lower spending than expected previously. So that was something that investors were cheering on, that the company is really focusing, prioritizing on profitability and not just growing without considering that, hey, look, revenue is falling and your margins are falling. So overall, I think the stock price increase was justified. I still think that Meta Platforms stock is undervalued, and it still remains one of my top 23 stocks to buy for 2023. So that's all I've got for this video. Thank you for watching. I'll see you next time. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.